Hi, everyone. Hopefully this is starting. I'm Amber Leach. I'll be hosting this webinar with Tony Prinzo. Welcome to the NJAPM webinar on cash flow and its use in divorce. This webinar should take about 30 minutes. I'd invite you all to ask questions. You'll see on the bottom toolbar of your screen, there's a chat function, and you can type in any questions throughout the webinar. We'll also have a time at the end of the webinar for Q&A. First off, I'll start off with introductions. I'm a divorce mediator. I have my own private practice, all mediation services. I am also a certified divorce financial analyst, soon to be financial advisor with Rich Planning Group. I am trained in civil mediation and on the court roster for that. I am also on the board as a director of NJAPM. So welcome everyone. Now I'll let Tony introduce himself and we'll get started with the webinar.
Thanks, Amber. Good afternoon, everybody. My name's Tony Prinzo, and I'm a forensic accountant. I've been doing accounting for about 30 years now. I started out in public accounting, doing tax, audit, write-up work. I've been a controller for an environmental engineering company for 11 years. And about 17 years ago, I got involved with forensic accounting. And 4 years ago, I opened up my own practice. Tony Prinzo, Forensic Accounting, Business Valuation, Mediation Services. I'm a mediator with the NJAPM. I also do special civil in Hudson County. And that's pretty much my background. As for my practice, I do a lot of business valuation. I do business breakups, stockholder disputes, internal revenue service investigations, damage claims, but it seems like the majority of my practice is concentrated in matrimonial and doing divorce work.
So in divorce work, you're often hired as a forensic accountant or business valuations, but how are you typically engaged? How do they bring you in a divorce mediation?
Usually in a divorce situation, there's three things that I'm asked to do. One would be to determine the cash flow, which is what we're going to talk about today. The second would be to value a business. And usually the third is the tracing of assets, where one spouse wants to know where the money has gone or where it is in the whole divorce situation.
So at what point in the process do people bring you in? At the beginning, middle, the end? What do they identify and say, I need a forensic accountant and I'm going to hire Tony?
Usually I get involved pretty early in a case. The attorneys or the parties will bring me in very early because what I do in the terms of the cash flow or the business valuation needs to be done in order to move that divorce forward and to get to a resolution in that matter. So I get involved pretty early in the case.
Can you talk about your approach with helping out in mediation?
Sure. When I look at a case, just like any other mediator or any other forensic accountant, we break the case down into about three different components. And the three components are common to almost all divorces. We have the alimony component, we have the child support component, and we have the equitable distribution component. No matter what divorce we're doing, usually one or multiple of those three are involved in the divorce. When we're looking at the alimony component, the cash flow is required in order to determine what kind of alimony number we're going to come up with between the parties. In child support, again, we need cash flow in order to determine how much the child support is going to be, and also how we're going to allocate that child support among the two parties. In a business valuation setting for equitable distribution, we usually value the business for small to medium-sized businesses. We look at them in terms of the cash flow. Usually they'll sell for some multiple of cash flow. That's what the person is buying.
Okay, so you look at the cash flow in divorce. What other things do you look at when you're assessing a case?
The first thing I do when I'm assessing a case is I want to look at the type of parties that are involved, you know, the spouses, what do they do? And when I look at them, I typically break them down into 4 different categories or 4 different types of people. One type would be your W-2 wage earner. Another type is your executive or your highly compensated officer in a company. The third is your retired people, people with passive income, or people with inherited assets. And then the 4th category is usually the business owner. You know, somebody that owns a business, they do it, and that's the 4th category, which is typically the most complex of the 4. Now, in looking at the 4 of them, like I said, the first would be the simple W-2 wage earner. This is a person that has a job, they get a salary, they get their wages, perhaps at year end, they get a bonus, but all this is included on their W-2. They're pretty straightforward. Everything gets reported on that W-2, so you look at it and you know their cash flow immediately. And we can use that for the alimony or the child support. The second person would be the highly compensated officer of a company or an executive of a company. These people will typically get their salary, get their bonuses, but also on top of that, what they'll get a lot of times are stock options or restricted stock units. Now this makes the picture a little bit more complicated when looking at it. And again, when we're talking today, we're talking in terms of generalities and just things you should look at, things you should be concerned about. We could have a whole separate seminar just on doing stock options and restricted stock units because they get pretty complicated. But getting back to that executive, this is a person, again, that gets those restricted stock units or stock options. And typically, a piece of that will be included in their W-2. But what we have to look at is what happens when these stock options or restricted stock units vest or they're exercisable. And when you look at it, you have to look at the history of what this person has done. One, have they always gotten stock options or restricted stock units? If so, how are we going to look at those? Because when they're exercised, you have to include that in the cash flow. Conversely, if this is a one-shot deal and for some reason the company was bought, the company was sold, something like that, and these stock options or restricted stock units are an anomaly, you really can't include those in an ongoing cash flow calculation. But for other purposes, like I said, if they typically have been getting them, we want to include that in their cash flow.
So you're talking about the restricted stock units or stock options in terms of cash flow, but are they ever looked at more of an asset, like like a pension, bringing in pensions, looking at as an asset rather than looking at it through cash flow?
Yes. What'll happen sometimes is the parties will decide, okay, we're going to value these stock options as of the date of divorce or as of some agreed upon time. We're going to figure out the value of them, and we're going to give the other spouse a piece of them in equitable distribution. So here we are considering them like an asset and not for ongoing cash flow. What we could do in certain instances too is, as of that date of divorce, we know the stock options or restricted stock units that have been acquired to date. And as they exercise moving forward and they're made into cash, we can give the spouse her portion as they vest over the next coming years. That's another option to look at. The third class of person or type of person would be a person that's retired, a person with passive income, or perhaps a person with inherited assets. Now, with this type of person, like let's say a person with a pension plan, their cash flow is pretty much set. They know what pension they're getting. They have their investments. They have their portfolio. They might have a 401k distribution that they get, and that's their total cash flow. But when we're looking at this, one thing we have to keep in mind is how much of that portfolio will this person be giving up in equitable distribution? If we're taking their portfolio and we're cutting it in half, that amount of the cash flow is not going to be there for alimony purposes. Typically in a situation like this, where we're dealing with people with pensions who are elderly or older in age, child support's not usually a factor. So in a case like this, we'll be looking at an alimony and an equitable distribution part. When we're looking at inherited assets, the inherited assets in and of themselves are usually exempt from equitable distribution. But the income that gets thrown off from that portfolio or those inherited assets can be and will be included in the calculation of cash flow. We have to look at that as the person's cash flow because it's available to them on a yearly basis. Also, what we could do is similar to like what you just said, Amber, with the stock options and the restricted stock units. There are instances where we'll value a pension in terms of an asset also. We'll bring it to an actuary because it gets to be a pretty involved calculation. They'll come up with a present value of that pension as of the date of divorce or the date we agree upon, and we'll pass out that inequitable distribution. So then we don't have to worry about it on a moving forward basis for cash flow. The fourth type of person is the most complicated. This person is the business owner. And the business owner has control of their company. They can control the cash flow, when they get it, how much they get, because it is their company. They can do what they want. But in looking at this, the situation tends to get more complicated because there's a lot more things involved with the business owner. One of the most difficult things in doing a divorce or a mediation with a private business owner is getting the documents. This seems to be always a fight to get documents from these business owners.
Can you explain why they'd be hesitant to give you documents, even though they want to move the divorce forward?
Exactly. They want to move this divorce forward, and then they don't want to give you the documents to look at in order to help them do that. And what happens in a lot of cases is they're afraid. They're afraid to hand over these documents because, maybe there is an issue of unreported income that they're not running through the business. Maybe there are a lot of expenses that are personal in nature, and they don't want you to know that either. So they're hesitant to give you these documents to look at. And that's the whole essence of how we look at the cash flow for a small business owner or a business owner. Now we have to keep in mind in situations like that where it's difficult to get to the documents, we have to remind these business owners that, hey, if we go into court and we start talking about things and there's an issue of unreported income or excess business expenses, and that comes out in open court, the judge is going to be under an obligation to turn this person over to the taxing authorities. So you don't want that. We want to settle this outside amongst ourselves in a mediation setting and get it resolved. I tell them, I'm not working for the Internal Revenue Service. I'm not going to turn you in. I just want to get to a cash flow number to help you with your divorce, maybe value your business if that's what's required, and help you get along with this divorce. I'm not turning you into anybody.
Right. So once you do get all the documentation, or a mediator gets all their documentation, what are the red flags, or what are the areas mediators should look for when they see there's a business owner that's involved and looking through sort of expenses where cash flow can show up?
Well, we're going to look at the entity. We're going to request those documents, such as the detailed general ledgers, and we're going to start going through them and analyzing them. One of the first things that I'm going to look at in a business owner or a company, or looking at cash flow, because remember, everything we're talking about here deals with cash flow. And again, the alimony will be a function of cash flow. The child support will be an element of cash flow, as will the equitable distribution. So the first thing I'm going to look at is to see what reported cash flow these people are taking. And what I mean by that is I'm going to first look at their W-2, if they get a W-2. How much is the W-2? And that's going to go to their cash flow. The second thing I'm going to look at is maybe the draw, because maybe it's a partnership and they're not getting a W-2, but they're taking out their compensation in the form of a draw. So that's going to be the first two things I look at. Now I'm going to start going through the profit and loss statement. The first thing that I'm going to look at is usually the automobile expenses. We look at the automobile expenses and we're looking at the detail behind it as to what's in that category. And we're looking for things that are personal in nature, which have nothing to do with the running of the business, but are being expensed through the business. So in essence, this business owner is taking out additional compensation disguised as these personal expenses. So an auto expense, a lot of times what you'll see is the business owner is paying for the spouse's car, the spouse's lease on their car, the children's leases on their car, and they're putting them through the business as a business expense. Those are really cash flow items which have to be accrued to that owner. The other thing that we're going to look at in automobile expense is the type of car that this owner has. If they're leasing, let's say, a Maserati or something for $1,000 a month, is that really necessary? I mean, the other side is going to say he doesn't need a Maserati to go visit his clients. So maybe the difference between the Maserati and a normal car, that will be included in the person's cash flow. Another thing that we're going to look at on the profit and loss statement of this company are meals and entertainment. What will happen in this instance is the business owner will take out the family for dinner, they'll take out some friends for dinner, and they expense it right through the company. Again, it's got nothing to do with the company. And again, we're only looking for the personal ones. There could be legitimate expenses in those meals and entertainment to take out clients, because that's part of getting your work. So you have to kind of look through the backup behind that to see what is personal and what's business in nature. Another category that we typically look through as forensic accountants and to get to this cash flow number is the travel expense. You know, is this guy a local guy? Is he, all his clients are local and there really is no reason to travel, but you see travel expense, that could be personal. The other thing is maybe somebody went to a conference or a seminar, and the conference or the seminar was for 4 or 5 days, but they stayed an extra 2 weeks on vacation and they tacked that on. So now you need to look at the documentation for that too, to maybe carve out that personal side, and that gets added to that person's cash flow. Another category we look at is the telephone expense. It's so much easier to pay the entire family's cellular phone bill in one shot, but the kids' cell phone bill and their internet and all that stuff that they're on has nothing to do with running the business. You're running a personal expense through the business and should be added to your cash flow. Another thing that we're going to look at is payroll. In terms of the payroll, a lot of times what will happen is you'll have a spouse who doesn't work there on the payroll, and they're taking the business deduction for it. That would be additional cash flow to the owner. Or, by the same token, you have a spouse who's working in the business, has a job legitimately, But let's say it's a job as a bookkeeper for $30,000, and that's what a typical bookkeeper would make. They're paying them $80,000. So now we have a $50,000 overage in what they're paying them. That'll be attributed to the cash flow also. Something else that we look at is the profit sharing or a pension plan for a company that this owner has. Sometimes what will happen is they'll say, I'm taking out 15% of my salary, and that's going to be the company will match that, and that's my payroll deduction, my contribution into the 401k, I'm sorry. But you start to look at their W-2, and they have absolutely no withholding for this 401k. The company, in essence, is picking up that whole expense on their behalf. So really, again, this is a cash flow item which should be included in that person's distribution, that person's cash flow. Another instance or something else we're going to look at is medical expense. The company might have a policy whereby the employer pays 60% and the employee pays 40%. Again, you look at the owner, his W-2, there's no withholding in there for his portion of the premiums. Now, that 40% you have to accrue to his cash flow too, because he's not paying it and he should. The company's picking it up on his behalf. Another thing is medical expense. Just like in that profit sharing plan, is they have the medical expense, they're not paying anything towards it, and that should be a cash flow item too. Then you're going to go through the insurance categories to see if the spouse's car is covered again, where she doesn't work in the business. I mean, I've gone through general ledgers and I've seen things like the homeowner's insurance policy is paid through the business, a shore house is paid through the business, boat insurance is paid through the business, ATV insurance. Those all things are personal and have nothing to do with running the business and should be added to the owner's cash flow. Another thing might be dues and subscriptions. We're going to look through here to see maybe they have Jets season tickets, Giants season tickets, Yankee season tickets. And again, it could be a legitimate expense, but if they're only taking somebody out 2 or 3 times a year, the majority of that is personal in nature and should be added to their cash flow. Another thing that we're going to look at is repairs and maintenance. I've seen things that are run through repairs and maintenance for kitchen renovations, for deck additions, bathroom renovations. Again, it's got nothing to do with running the business. And one other thing, I was looking back at meals and entertainment, I've also seen things that get added in there, such as bar mitzvahs, weddings, sweet 16 parties. Again, that's got nothing to do with running this business. The last thing that we usually look at on the profit and loss statement is the credit cards. You look through the credit cards because what they do is they'll pay one big credit card bill at the end of the month and it's done. You start looking through the actual charges on that credit card and you'll start seeing things like Bloomingdale's, Neiman Marcus, Joseph A. Bank, all this personal stuff. Again, should have been paid by them personally, but they're running it through the business as a business expense and should be added to their cash flow. But then you'll also look at through the whole profit and loss statement to see if anything else jumps out at you that you should take a look at. And once we do this, we might require some documentation of these owners, in support of something, or to see what is in that category.
What else would come up for cash flow outside of looking at these expenses and that you would find through the, the company's documentation?
Well, when we're looking at the business owner's company, we're going to look at it in its totality. So we have to look at the entity as a whole. So we're also going to look at the balance sheet. So to add to this person's cash flow, one of the things we're going to look at is the distributions that come out. That might be clearly visible on a K1, and there's no no argument with it, but it does get included in their cash flow. Another thing we're going to look at, and starting at the beginning of the balance sheet, is the cash account. Perhaps this business owner is hoarding cash or keeping this large amount of cash in the company. There might be divorce planning involved, but there might not be. You know, it all depends. But for instance, let's say they have $100,000 excuse me, in cash sitting in the bank on the balance sheet. The company only really needs $50,000 of cash to operate for the next 6 or 8 months. So that $50,000 differential between the 100 that's sitting in the bank and the 50 that they need for operations is excess cash. That could be included in that person's cash flow because it could have been distributed out to them or taken as some type of distribution. Another thing that we might look at is the officer's loan account.
Mhm.
When you look at the officer's loan account, what's happening with this account? Is this business owner taking out loans out of the company year after year after year? In essence, what they're doing is they're taking a distribution and they're making it a non-taxable event, and there's really no need, there's no intent for them to ever repay this loan. They just keep taking money out, keep taking money out. So that should get added to their cash flow. So those are the big things on the profit and loss statement. On the balance sheet that we would look at for this person's cash flow.
How far back do you ask for documentation? You know, would you ask your clients for? I'm sure it depends on the type of business, but for documentation, how far back do you look at?
It varies and it depends. One of the things you have to do is you have to talk to this business owner and you have to see what's going on in their business. What are the trends? What are the trends in the industry that's going on? What we try to do is we look at 5 years worth of documents. 5 years will give us a good indication of the ups and the downs in this person's business. It'll cover a complete business cycle, typically a 5-year period. But again, it depends on what this person does and what's happening in their industry. For example, if you look back 20, 25 years ago, one of the big things were beepers. A beeper salesman made a lot of money. Everybody wanted a beeper. But now there's no need for that technology. So beeper salesman compensation or cash flow would be almost nothing. Again, in another instance, you look at a doctor, a general practitioner. In his industry, their profits or cash flow have been declining because of reduced insurance reimbursements. So again, you have to look at what's happening in that industry, talk to that business owner, get a feel for what's going on. And by the same token, if a person's compensation has historically been rising or increasing year after year, maybe by some type of percentage, we might want to do like a weighting. Maybe we look at the 5 years and we put the most weight on the most current year. Conversely, maybe this is an industry that's going down. And now we're going to put the most weight on the current year because the trend in this industry is to go down. So again, it depends and you have to talk to the people, but usually 5 years of documents is what I'll ask for.
Okay, we are getting to the end of our half hour. I wanted to check if there were any questions. I see Bob McDonald has written, but there's no question.
Let me put up this chart that I did, which kind of summarizes exactly what we talked about. Hopefully this will work. So bear with me and we'll see if it does it.
Share screen.
Okay. Can everybody see that?
Mm-hmm.
Okay. So here we started with this person's salary. We included the distributions. So this business owner is claiming I make $125,000 a year in his cash flow. So we would look at that number and we would use it for the alimony and the child support number. But now we start doing our analysis, and we notice that, the stockholder loan has increased over $30,000. The excess cash sitting on that balance sheet is $50,000. And then we go through all those expense categories that we just talked about. That's another $100,000. So now this person's cash flow is actually $305,000. So we have a $180,000 difference between what they told us, the 125, and the 305 that we've uncovered or determined to be his cash flow. That could be a change of almost $60,000 in that person's alimony. So this just kind of summarizes everything we just talked about.
I did get a question finally. What about the reluctance of a small business? And this is from Robert McDonald. Very small business, like a solo contractor, maybe he has a truck, he has his tools, and they're going through a divorce, and you see that they're a business, and you mention to them, well, you need to get the business evaluated, and they don't want to spend the money for a full evaluation.
Mm-hmm.
What do you say to clients like that?
There's a number of things you could do to determine their cash flow and or value their business. Sometimes what you'll do is you'll do a preliminary look through things to see what their revenue is. And then we can go to some market data, and we can see that, this construction business of this type sells for, a multiple of 60 cents on the dollar, or 60% of sales. You can look through other sales that have happened for a similar industry, a similar business, see what they have sold for. Or again, you can do a quick analysis, of that profit and loss statement in the balance sheet. And instead of doing a whole formal report, you can give them types of calculation schedules. And sometimes that's enough to move this case forward. One thing we didn't talk about, which comes up a lot, are cases with unreported income. You look at the person's documents or the person's tax return, and they only show that they're making $30,000 a year. But they live in Alpine, they drive a new Mercedes every year, both kids go to private school. Now you're starting to look at the lifestyle. And the lifestyle is not supported by the cash flow that they're reporting. So here we're going to have to do an in-depth lifestyle analysis to determine that cash flow. And there's a lot of documents that we're going to have to ask for later on in those.
Yeah, so basically a small contractor like that wouldn't need a full evaluation for the court. You could do a sort of quick and dirty calculation.
Right. I mean, you have to keep in mind, what the purpose is we're doing. If we were going to do a mediation, everybody agrees to a mediation. And again, we're talking generalities here. What we'd like to do is get this done as quickly and efficiently as possible. Perhaps schedules, we all sit down and we do the schedules. If this thing progresses and the parties are not getting along and we're going to start moving towards a court date or a trial, we might enhance that. We might do a calculation report and see if that's okay. If it gets to a full-blown trial, then we're going to need to do a full valuation report.
Okay, great. I think we're getting to the end of our time, and I don't see any more questions. So I'd like to thank you, Tony Prinzo, for sharing your expertise with us. I hope everyone got a lot out of this webinar. Thanks for attending. NJAPM will be recording this and putting it on our YouTube channel, so feel free to visit it again, share it with others, and thank you very much.
And if anybody has any questions and want to reach out to me, my email's tprinzo@anthonyprinzo.com. Again, thank you for your time.